On this month's market update, the National Association of Realtors have released July sales figures. We'll talk about current inventory conditions and what that means for prices and the current market dynamics.
We're seeing signs of rising inflation and a weakening in the labor markets. Should buyers be spooked, or is this a potential opportunity? Find out today.
We'll tie all that together with a discussion of Fed policy and the potential path of mortgage rates for the rest of the year.
All this and more in this month's market update.
Welcome to this month's market update. If you've been watching for the last couple of months and you had find the content valuable, really hope you would click like and subscribe for us. And if you know anyone else you think would benefit from this, please share it with them. Gabi, how are things going?
Things are going really, really well. It was wonderful to see you, Ruben, just a couple of short weeks ago at our summer convention, Keller Williams Realty's mega camp in San Antonio.
Yeah, we were just on stage with Gary, giving a market presentation. We've actually got some more up-to-date stats than what we had back in August. So let's dive in.
Let's.
NAR numbers came out. July was another fairly sluggish month. Sales were up about 2% from June, but year over year, we're only up about 1%. Inventory again was up. We're up about 15% year over year, about 4.6 months of supply. That came down. This month's supply came down a little bit because the pace of sales picked up, right? But when you look at the number of total listings on the market, that's still up 15% year over year, and it was actually up a little bit from the prior month. Maybe some of the more interesting news in the NAR figures was happening with prices. So we saw a relatively flat price year over year. It was only up about 0.2%. And when you look at it regionally, we saw a lot of variation. About half the country we saw go backwards in price year over year in July, and half the country was up, with particularly the Northeast being up the most.
Right. And having looked at the different territories just a couple of months ago, it's been interesting to see that the West Coast really hasn't had that trend. They're the ones who have been really stale when it comes to those types of adjustments.
Yeah, so, when you look at the numbers, the West Coast actually saw negative prices, right? They're down 1.4%. They saw the biggest dip year over year. The South also negative, but a little bit less, about 0.6%. And that's a pattern that we've been seeing over the last couple of months pretty consistently, right? The South has just been lagging behind the rest of the country in a lot of ways.
Yeah. And the word really is flat, flat, flat. I mean, across. We're seeing when we're talking about these adjustments, these are small adjustments that, we wish were different, yet they are just that, very, very small adjustments.
Yeah, I mean, the bigger feel of it is like coming off the peaks, right? When you look at the peaks, you've got cities like Austin that's down almost 15% from the peak. You've got a lot of cities in Florida that are similar. The West Coast of Florida shows a lot of weakness in terms of pricing, and then Central Texas are the two worst kind of places to be in terms of from the peak. But if you look at it from, say, 2019, a lot of those places, the prices are still up 30-40%. They're if you look at it on an annual average, it's above our kind of like 4% line, right? So we're seeing kind of a correction back down toward what was more reasonable. But if you bought your house in 2023, 2024 even, these price dips feel huge, right? Like 15% off of the peak feels like a lot if you happen to buy at the peak.
Yeah, absolutely. And you also mentioned some of the inventory that has moved, some of the trends that we're seeing ever so slightly. There were some buyers who took advantage of those late summer months before school started, and yet overarchingly, we're just not seeing more buyers getting into the market to scoop up the inventory that continues to rise across the territories in the U.S.
Inventory's on the market longer. We're also seeing new listings haven't slowed down as much as a lot of what we see this time of the year a lot. Usually they typically peak in May, which they did this year, and then they steadily trend down. That downward trend has been less pronounced this year. So, that's part of what we're seeing is sort of this like building inventory in a lot of the markets, and particularly, again, the South, Florida, Texas. Those two states account for almost a quarter of U.S. home sales. So when you look at national statistics, Florida, Texas, California, that combination tends to have an outsized impact. And those are all states where we've seen sales slower than normal. We've seen inventory starting to accumulate. California is not quite as pronounced in terms of, the amount of inventory on the market, so compared to what we're seeing in Texas and Florida. But they have seen a decline in sales. They've seen slower price growth, even negative price growth in certain markets. So that's all kind of weighing down these national figures.
We've seen an interesting exception up in the Northeast corridor. We've been talking about the Northeast all year. And what are some of the changes that we're observing there?
Yeah, so it's interesting, right? We've seen the Northeast kind of outpace the rest of the market for most of the year. And in a lot of markets, it still is. But when we look at it now, in aggregate, right, like on as a big chunk up there, we're seeing a little bit of a slowdown. Prices were only up 0.8% year over year, where earlier this year, we'd seen above 5% year over year increases right there. We almost 10% in some places. There's still pockets like that, but when we look at it on a whole, it's a little bit less. Sales as well is flat year over year in the Northeast. So, we're starting to see a little bit of this slowdown perpetuate through other parts of the market that had been a little bit isolated from it. The Midwest is doing a little bit better. Their prices were up about 4%, but their sales have slowed down some, right? So like their inventory conditions there are a little bit tighter. When I was looking at it earlier, a lot of markets there are still under 3 months supply. The Northeast is still really in that ballpark too. So things have slowed down a bit, but their supply is still very limited versus when you look at the South, places like, Texas, you're seeing around 5 months of supply. Florida's in the high 4s. California, I believe, was in the high 3s. And then in other parts of the West, you look at the kind of we call the Mountain West, right? So Colorado, Idaho, Montana, we've seen more weakness where they've been trending up into the 4s in terms of month supply as well. So, there's a lot of different dynamics playing out, but it's increasingly starting to look like the country's going to kind of gel a little bit in terms of this sort of like increasing inventory, relatively sluggish pace of home sales. Affordability is a challenge across the board. We really saw it first in the markets that saw the biggest booms right during the pandemic period. We still, the Rocky Mountain markets we know boomed during that period. Austin boomed during that period. Florida boomed during that period. So they kind of were the first to see it. And now we're starting to at least see the first signs, right, that other parts of the country may be starting to slow down a little bit compared to where they were in terms of building inventory on the market.
Well, let's touch base on some of the other economic factors that may be contributing to the sluggishness. Let's talk about the labor market adjustments that we are starting to see, as well as inflation and what has been happening recently.
Yeah, so, it's made the news. There was a big downward revisement in a bunch of the employment figures that had come out this year. We were really only averaging around 30,000-ish jobs per month for the last really quarter. That's a little concerning, right? We came down from averaging in the close to 150,000 jobs a month to down to like 30,000 jobs per month. I think in July, we added about 70,000. It's been getting a lot of attention, a lot of political maneuvering around it. But in the end, what it shows is that it's one more factor showing a little bit of weakness in the economy. When we were on stage at Mega Camp, we talked a little bit about job openings versus unemployed people. Those two things have come back in line.
The interesting thing about this is we're on the border of having more jobs than we have people to employ. That's going to flip in a second to what?
There's not enough opening jobs to employ the people who are unemployed. So we've seen the new jobs report was a little lower than they expected. So they're starting to see the early signs that there's going to be lower employment. And we talked about certainty.
That's
if
right.
I'm uncertain, do I want to take on a lot of fixed salaries right now?
Yeah. What this chart's basically saying is that at some point it flips and you have more people looking for a job than there are jobs to give them.
We're seeing that. We're seeing unemployment among the young trend up faster. So amongst people with both college educations and without college educations in the sort of 22 to 26 year age group, like that unemployment rate's been kind of steadily trending up over the last couple of years. That's also potentially a little bit of a bellwether of like where things are going. In the end, we're trying to watch these signs. The signs are there, right? And there's alarm bells going off a little bit in the labor market right now that things are trending in the wrong direction. When you look at it in aggregate, again, the unemployment rate's only 4.2%. That's a pretty good number. Even when you look at the total number of the unemployed population, it's really not trending up very much. You're seeing these signs in these kind of subgroups in different places where it's being impacted, but there's still time to react, right? So that's where the Fed's kind of weighing things, right? Like which thing do we need to react to first? Because as you also mentioned, inflation's a factor right now. So another thing we talked about a decent bit at Mega Camp on stage, the CPI report, right?
And this is the Consumer Price Index.
Yes.
Right? Yeah.
So inflation. So you were telling us backstage, go ahead.
Yeah, so we got a new report this morning. We saw CPI hold relatively stable at 2.7%, but core CPI, where we remove prices of food and energy, moved up above 3% for the first time in quite a while. We were at 3.1%. The largest increases we saw flooring, 7% year over year, living room furniture, 7% year over year. So things that are
goods like washers, dryers, refrigerators, a lot of the stuff that we put in our homes.
Yeah, so a lot of home goods, particularly things that get imported, are now starting to see what we call pass-through effect, right? We see the price increases moving through the market.
Okay, so it's your opinion that tariffs do eventually raise prices in some way.
Yeah, it certainly seems that we're starting to see in the data now. That kind of trending in the wrong direction, it creates a challenge where it's really hard to both head off labor market weakness and head off inflation at the same time. We talked a little bit about sort of stagflation from stage as well, which is really what you get when you start seeing, that's the future we're worried about right now. I wouldn't say that's the reality of the present. It's more of a concern, right? And what that is essentially you get into a situation where inflation is going up and unemployment are going up, and they both get to elevated levels at the same time. The policy for dealing with each of those issues is to move interest rates in opposite directions for each one, right? For high inflation, we need to increase interest rates to slow down consumer spending, to slow down price increases, right? For unemployment, we need to decrease interest rates, right? Because we need to stimulate consumer spending, to stimulate the economy, get money circulating, create more jobs. So these two things are like at tension right now, right? Like they're pulling in opposite directions. The time this happened in the past, the solution in the end was that we got a Federal Reserve chairman that stepped in and said, I'm going to solve inflation. Employment will eventually take care of itself. So if we end up at higher unemployment, so be it. And he jacked rates up. We saw interest rates that were 18, 19% at that time period, right? We'll kind of see how that plays out. We're not there yet, but that's like the fear at the Fed right now. That's what's keeping them rates paused, right? They don't want to end up in that situation. So if they can keep inflation tamped down longer and with unemployment still in a relatively good place, they feel like they can kind of push it off and wait, right? So they're trying to, measure and trying to figure out which of these two problems is worse right now and which one's going to be worse if I don't deal with it sooner in the future. So frankly, I don't envy their position. That's a really hard spot to be in to try to figure those things out. They've got a lot of data to work with, but the business of predicting the future is not a good business to be in.
And yet the challenge continues to be that there's this air of uncertainty that is being felt, and it is having the impact in real estate. If folks are uncertain about the futures of their job or whether or not they would be able to make a transition into a new job with new income, then one might rather just save the money for now, right? Build that safety buffer, because we also know that, the average American doesn't have much of it right now, and simply not move.
Yeah, so that's the fear, right? At least in our industry, that there's all these buyers that are just going to start leaving the market. But we're seeing different things in different spaces, right? We were talking earlier, in the investor markets and markets where buyers have larger cash to put down, there's a lot of opportunity right now out there, right? We're seeing more listings on the market, more choices. Tell us a little bit about that, because I know you've been working personally with some investors, seeing some interesting things like rates that builders can do. It's kind of fascinating, the opportunities out there. I feel like a lot of people aren't talking about right now.
Well, and that's the tale of the other side of the story too, right, Ruben? Because while we have this inventory rising, it is a bit surprising to notice that we don't have more buyers that are coming into the market right now, whether, yes, they are those hobby investors that are buying, right, because on one hand, they may be seeing stale listings and they're able to write offers on properties that are on the MLS that have been sitting for some time. And with those who are, still motivated sellers that must make a move, that may be the first and the only offer that they have been seeing in months and months and months. So of course, it can be an opportune time, depending on where you are in the country, to be able to take advantage of it. But let's also acknowledge your average residential buyer that has had the pre-qualification letter and that has been looking for some time. With inventory continuing to rise, for some buyers, it's a wonderful time to move up or to trade their existing home in for a new one. We're seeing across the country that in places where builders have been building, they are sitting on inventory and they have to trade it out as well. So concessions are king right now. And some of the recent stories from here in Texas or in Florida, where those large builder accounts exist, we are seeing concessions that we haven't seen in many, many years, where closing cost assistance is being provided. Incredible credits if you're purchasing new construction. Incredible ways for renters to break their leases and for the home builders to pay for them. And it comes down to being able to clearly communicate your time frame and your motivation with your real estate professionals right now, because the opportunities are out there. One of the real life stories that I just heard from one of my coaching clients last week was that they were able to help an investor acquire several new construction properties at a steal at interest rates that the builders are begging them to take so that they're removing the inventory off their books before the end of the year. That, in addition to what we discussed on last month's podcast episode about bonus depreciation being in full effect again, this is an opportunistic time for more than just the hobby investors that may want to, scoop up 1, 2, or 10 properties. It may be a perfect time for someone to make that first acquisition as a first rental property, or for a traditional buyer to go to some of those strategic conversations of sellers who have been sitting on the market that may need to be educated on concessions that they should be offering, that they may not be offering yet because it's not listed on the MLS, and to be able to get into a property before the end of the year at frankly prices or with no closing costs, unlike what we've seen the last few years.
Yeah, I mean, you were telling me some of these properties are, new construction that's essentially going to cash flow once, you account for the mortgage rates they're getting from the builders on top of the depreciation, and that's, for new construction to cash flow is almost unheard of, right?
Absolutely. And here, I mean, the strategy that we used to become familiar with back in the 2017, 2018 years, depending on where you are in the country, was that somebody would take that bonus depreciation and then at the next year, refund of tax monies would just take that as another down payment on another investment property. And that was a rinse and repeat cycle for some investors that helped them acquire quite a few doors. Now, certainly with affordability, being at a different level now, including investors and what cash flows and what doesn't, it's an interesting time to go back to the drawing board if you are in the acquisitions game on single family homes, because depending on where in the country, you might be able to find some decent deals again to add to your portfolio now.
So mortgage rates, we already talked a little bit about Fed policy, about the things that are creating this tension. So let's talk about, I guess, a little bit of what might actually happen. The next Fed meeting's in September. Probably not long after you guys are watching this, I think a couple of weeks. Mm-hmm. Right now, the probability we get a Fed cut in September, if I believe the last time I looked, was maybe around 60%. I was looking at the Fed, kind of like the meeting notes from the last meeting that when they came out, and most of the people on the FOMC, the group of people who make the decisions about the rates, a lot of people talk about Jerome Powell, but he's one person on that board. He runs the board, right? 'Cause he's the chairman, but there's many voting members. Most of them were pretty much, we had 2 dissenters, but most of the conversation was pretty well in agreement with the idea of holding rates steady due to this risk of, potential higher inflation numbers. Since that meeting, we've had that CPI report came out after the fact, right? So they're now looking at potentially higher inflation numbers. There was another report that included things like wholesale prices on good that also showed quite a bit of inflation. So they're seeing that, but they also saw that labor market report also came out after the last Fed meeting, right? So they've got these 2 pieces of evidence pulling them in different directions. My gut says that they may hold off again, just because I think that there's the consensus, or the majority opinion seem to be that the bigger risk to the economy right now is letting inflation kind of become embedded. The Fed's willing to tolerate something like a one-time jump in prices, right? So if what happened was, say, tariffs is that, everything just jumped in prices overnight by 5%, and then from then on we were at 2% inflation, that doesn't necessarily need an adjustment from interest rates to prevent it. But if what actually happens is that policy kicks off a pattern of prices increasing by 3, 4, 5% consistently over months, and it looks like it's just continuing, that's what the Fed's worried about happening. So, there's some evidence so far that maybe we're not going to see that, but it's still early on. It's still kind of unclear how prices are going to adjust to the new policy environment, and people are increasingly concerned about employment. So I think, we may see more dissent at the next meeting. We could see a decrease as well. If we do, I think it'll be 25 basis points. If we get the decrease, what does it mean, right? I think we'll probably see a little bit of a decrease in mortgage rates in that case. We're probably talking about in the maybe like 10 basis points, because a lot of this is
We're talking about ever so slightly, right? We're talking about small adjustments.
Right, because a lot of it's kind of priced in already, right? Like one of the reasons we've seen mortgage rates drifting down over the last month or so is because of these reports, right? And we saw mortgage rates dip on that last employment report. The reason they dipped is because that employment report implied that the Fed was going to be more likely to lower rates in the future. So a lot of these things start moving before the Fed actually makes their decisions. right? So I wouldn't expect some kind of like big jump. We won't just see a 25 basis point disconnect, like drop just when the Fed announces it, right? If you go back and look through time at what happens, rates tend to trend down ahead of the meeting rather than as a result. The only time you see disconnects is when there's surprises. Now we are getting into an environment where like surprises become increasingly likely, right? So normally we've been going into these Fed meetings with very high, 90% probability of what their decision is going to be when you look at a lot of the markets looking at it. So we basically know what they're going to do ahead of time, right? These next couple of meetings, it's a little less clear. We've had dissent for the first time on the board in quite a while. There's a lot of political pressure building, and there's a lot more evidence starting to build that it may be necessary to start lowering rates again. So we'll see what happens. If we get a non-move from the Fed, we may see rates start drifting up a little bit. If we see the 25 basis point move down, we'll probably see them drift down a little bit. But again, what I don't think we're going to see is any substantial movement, right? We might get a little below 6.5% if we get the dip. I don't think we're going to see 6%. I don't think we're going to see below 6% off of one interest rate reduction by the Fed. What may matter more is how long it takes us to get an understanding of what the Fed's path over the next year is going to look like. And that's going to take time. We won't know that in September. Maybe by the end of the year, maybe a couple of months into next year, we'll get an idea of what inflation looks like post all these new policies. And that'll give us a better idea of the path. But that's what everyone's trying to anticipate. What does the path of monetary policy look like over the next 2 years to understand what a 10-year treasury should be worth and therefore what a mortgage rate should be worth? So long story short, right? Very long story, but we don't expect a ton of movement this year, kind of regardless of what the Fed does. A downward movement would be a move in the right direction for us in terms of helping affordability, but it's not going to happen overnight. We talked about this back in 2024 when the Fed was lowering rates, right? It wasn't just going to be a one-to-one movement. Rates weren't going to fall overnight. They could still go up even when the Fed's lowering rates. We've seen that before. There's a lot of other things impact this. So, it's something we have to keep an eye on. It's not going to happen fast. And there's a lot of uncertainty around it right now. So again, we're anticipating mortgage rates 6.5% for the rest of the year seems ballpark likely at this point.
It will be interesting to discover in our episode next month what will be happening after the Fed rate announcement.
Yeah, please join us next month. We'll talk about, the Fed announcement and everything else that's going on.
Absolutely. Hopefully, we're going to start discovering a little bit less sluggishness in the markets, although these things take time. So tune in next month as we start to discuss updates post the Fed meeting.